Yes, welcome. We thank God for today. We're about to start our live show on an understanding of the amount of work that we need to put in order to be financially free, financial freedom, passive incomes, and goal based investing. Goal based investing. Welcome, Mr. O'Brien. So basically, we talk about passive income. And by meaning the word passive means a state of inactivity. Passive incomes is what is generated by investments that we create. Potentially, we get to understand a lot to do with savings. We have a lot of information to do with investing, a lot of investing vehicles. But the question of financial independence and financial freedom is not elaborated enough. We don't get to understand it quite very well. If you look at our patterns of saving, our savings are based on what is available or what we can put in. We forget about there's a specific goal that we are supposed to be working on. And savings or investing is not supposed to be based potentially on what you have. There should be a goal. What is it that you're looking towards achieving? So in goal-based investing, the most important thing is identifying the goal, the reason why you want to do your investment. Why are you saving? Are you just putting a chosen amount of money to a certain account or investment vehicle on account of that is what you have chosen to put in there? Or you are funding your savings, you are funding your investment based on what you need to put in for a specific period of time so that you achieve or attain a specific amount of accumulation of capital over a given period of time, because that is what would be goal-based investing. The reason why financial independence is an illusion and very few people will achieve financial independence is that we do our savings, we do our investing on basis of emotions and not goals that we set. So the basic principle in attaining financial freedom. Hi, Mr. Gorilla, I can see you. Welcome. The most important thing that you need to consider in this journey to financial independence is identifying a goal. Because financial independence means nothing if you don't have tangible figures or amounts that you are set. You need to know the kind of incomes, because financial independence potentially becomes a replacement or a shift from you actively having to work to fund your bills or your lifestyle and substituting that with something else. Something else, because as Africans, there are parents or believe or think educating their children is an investment. And therefore, for such a person, they will put so much in the children in terms of education with the mindset that it is the children who will come to replace them in funding their lifestyle. Then that comes with a surprise, because this parent forgot that this child, as an independent person, once they grow, they will have their own responsibilities. So you are replacing yourself out of investment. Yes, welcome, James. You are planning the financial independence planning. You need to know where you are putting your money, how much you are putting in that vehicle, and how much you intend to grow that investment to, in order for this investment at one point to replace you in funding your own lifestyle. Otherwise, whatever else you will be doing, that is potentially saving, because in general, saving is basically keeping money, or a defensive way of handling your incomes, protecting your money from your expenses. To save, gender is to protect the money that you have from three things. You're protecting that money from yourself, because you are a potential threat to your money in terms of expenses. You prevent that money from being spent by you. Number two, you prevent that money from getting lost. And number three, you prevent the money that you are keeping from being devalued or losing its value through inflation. Because inflation is a permanent financial characteristic or risk that you cannot do away with. So you prevent your capital from losing its purchasing power. Basically, that is what saving is. But investing is deliberate assigning of the money that you save, of the money that you keep. You assign that money to specific opportunities with a purpose, where the purpose here is building or accumulating assets that in a given period of time will come to replace you. Those assets will generate so much income enough to replace you or to replace what you are generating actively. So passive incomes come to replace your active incomes, and it is that point where you say you are financially independent. You are freed from waking up to actively engage in activities that you generate money to fund your bills or your lifestyle. What majority we do, we save, we put money into vehicles, but potentially we do not know how much we require over what period of time. Because if you are saving based on a goal or a target, we say that for your goal, you set a goal for your investment, that goal should have 5 characteristics. Your goal should be specific. You need to be able to tell. If a question is posed, why are you need to tell specifically why you are putting in your money. Why are you investing? There should be a reason, and that reason should be so specific as a goal. And number 2, it should be measurable. If you are saving towards purchasing a car, you know the car, the value. If you are saving towards your financial goal, it needs to be specific. Yes, it's a financial goal. But the question is, how much? What size of portfolio, what size of investment do you require that will generate what you need to finance your lifestyle or your expenses? So for instance, A person who is earning 50,000 or a person who needs or requires 50,000 to cover their lifestyle or living expenses as a purpose of acquiring financial independence, this person requires to build a pool of assets or investments, what we will call wealth, that will be generating an amount equal or more than 50,000 that covers his needs. So that even if this person engages himself, retires himself from active work to doing passive work, to engaging other activities, this wealth will replace him in generating what they need for that, or the 50,000 that they required for their living expenses. So the next question would be, if I'm spending or I need 50,000 for my lifestyle, what will be my yearly need, which will be 50,000 times 12, giving me 600,000. That is my annual requirement. So I will look at the size or the amount that I need to build over time, that from the capital markets or the financial markets will be enough to generate for me passively an amount equal to 600,000. That is my annual requirement. That is I need for a whole year. And assuming an average, a possible average in the market, you cannot lose out, or you cannot tell me I'll miss out an investment that gives me a return of 10%. The current market rates are unprecedented. So we cannot apply the current return rates in the market as our target or desired amounts. Investing requires prudence, a principle of under expecting. You don't plan or do your analysis for placing your goals based on the highest returns in the market. You need to look for an average. And I like using 10% because 10% is less volatile compared to other rates. So if I have a size of 6 million, if I have a pool of investments to a tune of 6 million, at a rate of return of 10%, that would give me the 600,000 that I require if I'm spending 50,000 on a month. And that is a specific goal. That is a specific amount, a goal, and I've measured it in monetary terms, 6 million. So that the next question would be then, how much am I supposed to be putting aside or keeping on a monthly basis, on a daily basis, in order to be able to attain my goal of 6 million over a desirous period of time? A goal, to be a good goal, should be time bound. I need to know. And see, James, thank you. So I will need to be able to determine, because investing for financial freedom is a long-term goal. It's a long-term goal. It's a long-term plan. But it cannot be forever. It should be for a defined period of time. Depending on the size of your active incomes, you can decide or give yourself a target period of time over which you need to build your required portfolios that are generating what you require on an annual basis. But it's important to note that if you are earning 50,000 or you are funding your expenses to a tune of 50,000 today, that may not necessarily what you'll be requiring come next year. Yes, Mr. Kimani, you have a question? Welcome, welcome. You can post your question, I'll see it. and I will answer you. So switching from active income to replace with passive income is a personal choice. Retiring from yourself from active income to passive income, it's a personal choice. So you elect when you want to retire. So with that, the given duration or the point in time when you want to retire, that gives you the time factor in your goal setting. You have said the goal is specific, the goal is measurable. We have given it a time. That is the last element. But it's important because once you have measured the goal, the amount that you need to accumulate over time to generate you the desired passive income, we have given it a time. Then it's realistic and achievable. Should be realistic and achievable because the funding of your investment, funding of your savings depends on your active incomes. You cannot set a goal that requires. Yes, Mr. Simon, you can post your question. Funding of your investment or savings is dependent on your active incomes. So it should be within what you can afford. It should be attainable. It should be realistic. So if you're investing towards financial freedom and you don't know how much you need to accumulate in order for that wealth or pool of assets, what I would rather call a portfolio, is enough to give you the desired annual return, passive income, then I think what you're doing is not investing. Investing should be attached. Saving should be matched with a specific goal or a purpose. That is the most important thing. Then the other element, because that measures the amount of work that you need to put in your investing for financial freedom. Not the choice that because there is a money market that is trending and offers the very least that one can put in is 50 shillings, and that is what we choose to put as 50 shillings, 100 shillings in a day, for example. Because we have so many money market funds that give us initial investment and allow top-ups to a tune as low as 50 shillings or 100 shillings. And I want to use as an example of 100 shillings so that we define two specific times in your period of investing towards financial freedom. Invest or saving is the entire duration where the returns from those investments that you have saved towards are immaterial. They are not material enough. In finance or accountancy, finance circles, materiality is a measure of the impact of the money or income that you're receiving. Materiality is measured on the change or impact that money can have. Whatever I'm receiving as a passive income out of what I've saved, is it enough to take care of one of my expenses? Because we will have a goal should be divisible. You can divide, or that goal, you can divide it into smaller goals. For instance, as I had indicated, yes, Kimani, I will answer you in a short while. If I need or I require 50,000 on a monthly basis to fund my lifestyle, I can divide or allocate this 50,000 to specific expenses or bills. Rent, a specific amount, electricity, water, a specific amount, transport, another amount. I spread the 50,000, identifying each stream or vote of expense. So I can invest with the smaller goals, which I call blow by blow financial independence. You start feeling that independence, freedom, by dividing your ultimate requirement for financial freedom into smaller goals. You first invest towards replacing your rent expense with a passive income from a particular investment. You buy a specific bond. You save towards acquiring a bond that generates enough coupon or interest that can settle your yearly rent expense. For instance, a person who is living in a house that they are paying 10,000 shillings. In a year, they would require a total of 120,000 for their rent expense. I can choose my first investment to go towards settling my rent expense. I want to build an asset portfolio that generates enough passive income so that rent, I don't need to bother. I'm not bothered about rent because I know where that money comes from. Because the aspect of money that comes when we are sleeping is a description of the very least you can do or you can commit in exchange of what wealth is bringing in. When we understand, let me see, Kimani, what you're thinking. Okay, thank you. Someone who starts at 20 years and saves consistently for 25 years with the name of retiring at 45. And another guy starting at 40 saves consistently too for 25 years, aiming to retire at 65. Aren't they the same? The first answer is they are not the same. Not at all. They are not the same. Because my margins that you have indicated, one is retiring at 45, the other one is retiring at 65. This is an analogy of a typical economy like we are in, Kimani, that I'm taking a fortunate young man of 20 years, and because at 20 years, this is a person who doesn't have a lot of responsibilities. If this young man choose to be deliberate, to be objective, this young man can dedicate over 50%, is able to dedicate over 50% of their active income towards investing. At 20 years, whatever this person needs for their lifestyle, we cannot peg at it because that is not prime time. Investing for independence, we look at what you require at prime time. So an advice to a 20 years person who is investing towards financial freedom, we normally multiply, do it in multiples. If this person is leading a lifestyle worth 20,000, we will look at 60,000 because there are responsibilities that will come into play as the age of this person advances. But the good thing at this age is that this person has few responsibilities, but a lot of temptations. So it will require more effort for this person to dedicate, to commit, to be consistent in that investing. But if they choose to be deliberate and objective and they have a target, I want to retire at 45. What do I need to do? Because the question, again, what I will need to bring out, Bwana Kimani, is that retiring, let's not pick retiring typically to mean as the normal living service, living active service. Retiring in terms of investing for financial freedom is switching your dependency from your active income to passive income. That is what we mean by retiring under investing for financial freedom. It's not about age. It's not about quitting your job. It's acquiring control. If you are not financially independent, if you depend on your salary for everything, for all your expenses, by default, you become the most disciplined person at workplace. You can get insulted and get comfortable with it because at the end of the day, you choose to quit that job. Every other, you get reminded that there are bills that you need to settle. And that is a common phrase by many people. Even when they are faced with dangerous threats in their places of work, they will always question that, you would want me to leave the job? How will I fund my bills? And that is the kind of freedom that we are buying with investing. When you invest and you amass your wealth to a point where the incomes or returns generated by your wealth can sustain your lifestyle, can sustain your security bills, can sustain all your expenses, then you get control of your life. You get control of your life. So it's a question, do I want to acquire control of my life at 65 years, or I would want to acquire control of my life at 45 years? Do I want to be pushed around, abused at a workplace because of my bills? Or I need to choose the shortest time that I can dedicate my active incomes? I go flat out, monetize my skills, monetize my talent, monetize any ability to amass active income and put it in investments, assets that generate money that is enough to sustain me. That is the time you get control. I hope you're getting make money. It's not a question of we are not leaving active work, but we want to switch from doing things because we are under pressure of our bills to doing things because we are enjoying what we are doing. To be where we want to be at the right time when we want to be at that point. If I feel a certain job is oppressing me, if I don't feel comfortable, I don't have to be there simply because I'm under pressure of my bills. I can move out. I can even decide to quit and take time as I look for a better thing to do that makes me happy because I have another person called wealth, another person called my assets that is funding my expenses. That is what we are talking about in financial independence. Let me see what you're saying. When I say save, I mean save and invest. Let's assume they save the same amount, similar or through. Retiring is switching from your dependence on active income to passive. That's very good, yeah. That is what it means, retiring on a basis of financial independence. It is not the same. It is not the same. And this is the same. This is what I will bring out. This young man who is retiring, now that we are in the same page of switching, who is switching from active income to passive income in funding their living expenses at 45. Remember, that person is still working. After 45, they are still working. But they are working, they are actively engaging themselves in things that they love, things that make them happy. But they are still monetizing their skills. They are still monetizing their talents. They are making money. This is switching from active to passive does not mean that we now, when it is literally said that passive income is money that visits your account when you are sleeping. I think it's the simplest way of trying to put it or make people understand what passive income is. But who wants to sleep their entire life because they have either they have inherited wealth from their parents or they have succeeded in investing and building wealth that funds their bills? Will you choose to sleep? You will still be engaging in things. Supposedly, if this person, part of their wealth, they have built in equities. Equity in form of their own companies that they have established and invested in, but they have built good systems of control. They have delinked themselves from the daily running and management of the business. That is equity investing. Or they have bought stocks, equity, instruments from other companies. Does it mean that that person, when at the moment where they are relying on their passive incomes, now they choose to sleep or do nothing, they will still be making money? But I want you to look at this fella at 65. And we know once you retire at 45, these assets that are generating these incomes, and this guy is still able to work. Assume these two fellas are in employment. And naturally or legally, under employment laws, you are retiring at 60. So this question of 65 is far-fetched. So you are at 60. This other guy was at 40. They have retired. They have switched. The 40 has switched from active to passive in handling the bills. This person can choose to monetize their communication skills. So he goes around in seminars, making money, having monetized something that they love doing. There's this other fella who is still in office. They are investing the same amount. Get that part. There is no way these fellas should invest the same amount unless the guy who is retiring at 65 has a lifestyle that cannot compare with the other guy. If these people are having the same lifestyle, and for this purpose of investing, they are to maintain their lifestyle throughout, then the fella who is investing from 45 years to retire or to switch at 65 must be doing double the amount that the guy in 20 years is doing. Because they need to catch up. The period may look the same as in the span of investment, but the accumulation remember, our lifestyle is a moving goal. Our lifestyle, as I indicated, is a moving goal. Your lifestyle this year may not necessarily be the same 2 years down the line. Forget about a negative or a bad thing happening that pushes you to live or enjoy a lower lifestyle. Lifestyle at all times should be increasing. And that's why we say investing is assigning your money to assets expecting a positive return. So it means if I get a negative return, I'm supposed to switch that investment, liquidate that investment, and acquire a new asset that gives me a positive return. Because my lifestyle need not change negatively. My lifestyle will either be constant or increasing, improving. I hope we are together, Kimani. So with that in mind, then, we are cognizant of the fact that as you advance your age, there will need for more money. This guy who is at 40, who is retiring at 40, has the ability to generate more money, increasing the investments. Remember the magic of compounding. These investments are still piling, compounding. So these amounts are, the fella at 40, by 65, he'll have amassed more wealth. These people can never be the same. So the earlier you start your investing, the better. If you are investing at an advanced stage, you must do catch-up savings. Savings above what the younger person was doing. If you fail to invest in your earlier years, you are starting your investments at 40, 45, you need to do catch-up savings. But before we even look at the catch-up savings, Remember, we have said there has to be a goal. What is it that you want to achieve? How much money do you think it's enough for your lifestyle at the time you want to switch over? Because that amount that you want, it's personal. Financial freedom is personal. That amount that you want at that time, that is what guides you on how much you should be investing. But having a point of you have to start, even if now that you know what you need, it doesn't matter how much you start putting in. But knowing that if you are putting in lesser than what is required to achieve the specific goal that you identified yourself, you are going out to expand your incomes. You do a side hustle, you monetize assets in you that are not monetized yet. Because there is something that is very critical that most people don't understand. Financial independence, in a different way of explaining it, is a process of switching assets. We are retiring one asset to replace it with another asset in generating incomes to fund your living expenses. You are the first asset. What is an asset by definition? Any accountant or finance guy will tell you an asset is any resource or anything that has value and able to generate money. Has value and able to generate money. So what are the assets in you? What is it that makes you an asset? Because primarily you are the person who is generating money. You cannot save or invest when there is no money. Where does the money for saving and investing come from? It comes from you. So you are the original asset that is making this money. You are making the money utilizing your skills. You are making this money utilizing your talents. You are making this money utilizing your time. You are using your health. And you are using your influence or people. Those those 5 attributes, those are elements that define you as an asset. So to make more money, you need to identify out of the 5, which of these assets in you is not fully utilized or monetized. If it is you have a spare skill that in your skill set, there is a skill that you have that is not monetized yet, you put it to work. So this asset that is you has generated money. Money is also asset. Why is it that why we say money goes out to make money for you? Money goes out to asset is anything that is able to make money. So money becomes another asset. You are an asset. You created another asset called money. Then this money will be assigned by you to investments. You convert the asset money into another asset called an investment. Either a treasury bill, a treasury bond, IOU instrument, it could be stocks, could be a business, name of stock, an asset. When those assets collect together, when you accumulate the assets of investments, that is the time we call them wealth. Wealth is a collection of assets. Wealth is portfolio, collection of assets, which are investments. So if you look at that, that is a journey of conversion. The asset you made asset money converted into asset investment became wealth. So at the end of the day, remember assets wear out, assets depreciate. So this first asset that is you will keep on wearing out, depreciating over time. You are getting that. You have a specific time that you want to pull yourself as an asset out of the equation. And because you have expenses that are perpetual, you have living expenses. You live on your expenses. So when you retire yourself from this equation of generating money, you pick the asset that you created yourself to replace you in creating money, generating money for your living expenses. That is simply What it means by financial independence, it's replacing one asset with another in generating your money to cover your living expenses. So you must build an asset that is equal to you. And to be more specific, the asset that you use to replace yourself in funding your bills must be bigger than you. And that's why when we are talking of retirement, we say that your retirement income should be at least 150% of your last payslip. There are challenges that come with old age. When we are talking of typical retirement, we are talking of a person leaving employment at 60 years. There are challenges that come with old age. So that is simply what I put as in financial independence. It's a replacement. You replace yourself as an asset by another asset is generating money for your living expenses. Let me see. Another question. Yes, Kimani. And I kindly request you guys, subscribe to the channel. Subscribe to the channel, please. You can also share. You can ask questions like Simon, I'm waiting for that question now. As Simon, you are typing your question. Let's put something else into perspective. And I want to bring out a distinction between your saving time and investing time. The period over which you are accumulating your money, you are keeping money, and this money is not generating material returns. Material in the sense of you cannot rely on that money to cover any of your bills. What you are typically doing, you are saving. An example, take an example of a person who is able to putting in 100 shillings, an example of a money market fund on a daily basis. If you take a return, let's even assume a 20% return in that money market fund, which is an add-off. We don't have a money market fund that can give you that kind of a return. But for ease of calculation, if that is a daily yield of 20%, and this person has put in 100 shillings, how much a daily yield will this person get? They will get 2 shillings. They will get 2 shillings for a whole year. If you divide by 365 days, the amount of interest that has been earned on that amount for a day is so small, insignificant, you can't even record it or reflect in that account. But because at the initial stages of saving, we have a lot of emotions, a lot of trust issues, because our saving maybe has been informed through peer pressure. So this person keeps on checking the investment, the portfolio account, whether the amount is increasing. But whoa, this person is not, in the mind, they know that the investment should be generating returns. There is daily compounding. So 100 shillings, yes, because in mind, you know there is daily compounding. You expect to see a change on 100 shillings. But if you take the 2 shillings that you have earned for a whole year and divide this amount to get what you have earned for that first day, for it to reflect, it is in so many decimal places, you can't round it off to any nearest recordable or programmable amount. Then that person starts getting demoralized. It is not reflecting because you have not defined your timing, whether you are investing stage or you are in saving stage, although both comes simultaneously. Until the time your accumulated amount has started generating money that is material. If you are able to get like 1,000 shillings a month, I know 1,000 for many people, it can sort maybe electricity bill, it can pay your internet, it can pay. That's the time now you start feeling or enjoying. You start enjoying financial freedom. Financial freedom will not be enjoyed only at the time where all the interests and the dividends, the returns that you are getting from your investments cover all your expenses. No, you start enjoying the benefit and sweetness of passive money from when your investment starts giving you material return. Materiality in accounting and finance, it's a question of what that money can do. So for a person who is putting in 100 shillings on a daily basis in a money market fund, I estimate that person will start feeling and enjoying financial independence after 3 years, 1,000 days. Because 1,000th day atakuwa ameweka imefika 100,000. 100,000 will translate to 20,000 at a rate of like 20%. If you divide that one monthly, that person is getting 1,000 plus. Meaning that now, if this person forgets about the miracle of compounding and chooses to enjoy that passive income, at least that amount can start sorting out a bill here and there. And by so doing, they will have started enjoying the money. So, Kimani, I see your question. Let me see. In America, they say that it is the hardest to accumulate the fast. Oh, yes, of course. The fast in accumulation. You know, the problem with our economy is that because we are trying to woo people to bring in money to the fund for investing, we tend to use a lot of sweet words and a lot of soothing. But to make it specific, you are saving until you reach 100,000. You are investing is from 100,000. To be very specific. If you have less than 100,000, keep piling money. Forget about the return. Let the miracle of compounding do its work until you hit 100,000. If you get 100,000 in an investment on average of 12%, that is a person who has gotten 12,000 as a return. So this 12,000, assume you have gotten it as a lump sum. A bond will pay you 2 times, 6,000, 6,000. But assuming this amount you have received 12,000 as a lump sum, the perfect way to use an emergency fund account is where now you get the 12,000, put it in the emergency fund account, then do what we call a drawdown. Every month you are getting 1,000 from that account to pay maybe an expense. In Nairobi, I know many are paying their internet, whatever. At 1,000, you are able to get 1,000 and pay a bill. So independence is you generate the income, then take this income, put it in another account that cushions you from loss of that money and inflation, and also generates a return because the 12,000 I've dedicated it towards a bill that covers 1,000 per month for a whole year. So there is 1,000 shilling that will stay in that account for 12 months. Another 1,000 will go for 11 months. So for that period, the money that remains in the account needs to be generating me more money. We must understand the dynamics of investing and financial independence. So it's very true, my brother. The most difficult thing in investing is building your first 100,000. Once you have done your 100,000 and you have started receiving material return, the sweetest form of money is passive income. The moment you start enjoying the passive incomes, you get energized. You get energized to put in more money. Remember, this very fast, before you hit 100,000, you have nothing to encourage you. Because you are only putting in money, but whatever is coming out of that investment, somebody will tell you, 80,000, and you're only getting 8,000. If you put that money in business, you buy stock and sell it, you get more money. Those are form of discouragements that you start getting. But the moment you hit 100,000, figures start changing and you get that encouragement. And it's the most difficult thing to hit that 100,000. A person who is accumulating, packing, in order to build amount of capital. That is very true, Simon. So, what would you say is our 100K in the Kenyan context? How much should one accumulate? You are well on your way to wealth creation. I hope my question is clear. Very clear. I'll still give you that figure of 100,000, my brother. The most or the reliance, the benchmark that we use in the Kenyan economy, we rely on treasury bills. If it is interest rates, all interest rates are benchmarked with the treasury bills interest rates. When we talk of one being a retail investor, a small investor, and a big investor, we look at the minimum amounts that are required for investment in treasury bills. And treasury bills, you need 100,000. So ideally, what I'm saying is that the benchmark, what we look at to know that you have started, your journey in investment has started, is once you hit 100,000. You are able to buy at least two treasury bill, two bonds worth 50-50 in those multiples. So my answer for that question, Bwana Kimani, is once you hit 100,000, that is the time we say you have started the journey. And the most important part of it is what I've told you. It's about the return. 100,000, even if you're investing in a vehicle or an opportunity that promises you 10%, at least you are getting 10,000. If you divide 10,000 by 12, you'll be near 850, 900, thereabout, and that the money starts getting significant, starts becoming significant. I hope that one is clear. So I got your question. So I have Mr. Vex, brother, what can I do about, she uses about that 5% weekly of my income on wasteful clothing and junk. Wow. You only, Mr. Fex, just because that's your better half, and there's nothing much we can do, but you can reorganize the spending where you first prioritize what you are saving or investing. Pluck out what you need for the investment and savings. Put it in your investing vehicles. Then whatever else happens, you will be safe. The most important aspect is if you are able to save, if you are able to invest, that's good enough. Or you monetize other assets within you to make more money. So that bit, I'm still insisting on goal-based investing. If I ask you, Mr. Simon, if you are there, is your investment tied to a specific goal? Do you know how much of wealth you require to switch over from active to passive? That is the most important part. That investment has to be goal-based. There has to be a goal. You must know how much you need, how much you are putting in, for how long you need to put in that much in order to attain the desired amount over time. You're still here. So my question was, is your investing tied to a goal, as we have indicated? Do you know how much you need to invest in terms of volume to generate your desired passive income? So I hope we are clear in the switching. This is a movement. It's all about assets. It's all about assets. You are an asset yourself. Money comes from assets. You are the first asset. And assets need to be taken care of. Tomorrow I'll be talking about net worth. Assets need to be taken care of. And one level of taking care of the asset that is you is in the question of energy or your health. You are saving to build incomes, passive incomes, but how do you enjoy income or money when you are in a sick body? The most important thing when we are talking of saving, you don't just save money alone. Money is never enough. You are not saving money alone. You need to save time. Time is a resource. Yes, majority of us only save money, but waste all the time. We waste our health. You need to save money. You need to save your health. You need to save your time. These three are very important resources. If you generate the money, but you have no time to enjoy that money, you generate the money, but you are in a sick body that can't enjoy money. You need your health and you need your time. Those are other resources that you should accompany your saving of money to saving your time and utilizing the saved time in generating more money. Save your energy, that is health. Be in right shape. You are saving as you are dedicated money. You are saving to retire at 65. But you waste your health such that by that time 65 you are already a cabbage. How do you enjoy that money? How do you enjoy that money? The other part is the thought of investing in children. That you put all your money in children, you want to take your children as an investment. Children are not an investment. What we do to our children, we settle our responsibility. To their education, their health, their clothing, that is a responsibility. That is not an investment. Because that is a mistake. That is a serious mistake that many people do. Then once you retire to a poor village with the expectation that the asset that is you is now being replaced with children. Then the children are like you and I. Tunapiga sherehe town and we forget about you. You have need requirements as a retired parent of 50,000 for your lifestyle. The children that you thought they would replace that active income you are generating through your payslip by sending you black tax, they start sending you 2,000, 1,000, 3,000. Then you become a miserable old person. You become a miserable old person because you made bad decisions of investment. We don't invest in children. We educate children as their right, our responsibility. We build assets. Passive income comes from silent assets, not talking assets, arguing assets. Children, and they are arguing. Passive income comes from cash flow rich assets, which don't talk. They don't talk. Those assets don't complain. Your investment in bonds don't talk. But the children that you want to talk of, you have put your investment in children, and you want your passive income to come from your children. You want to replace your inability to generate money because you have retired with the ability of your children to send you black tax. You will curse all of them. Yes, Bwana Kimani, my desired passive income, 500K per month. Very good. From your video yesterday, I figure my portfolio should be amounting to 60 million. It's a tall order, but my dreams are valid. Very valid. And I thank you. I appreciate that you took something from that video. It's a person said by many. The easiest way to grow your wealth, Bwana Kimani, is through equity. Equity, buying stocks. And equity is in two ways. You either you establish yourself. That will be the first one. And I'm putting it as the number one because it's the surest way, but a bit challenging. You start your own company, which is properly structured with a good solution, because business is in providing solutions. If you're able to do that, nurture that business for like 5 years, then choose to sell stock, sell equity. Alternatively, you can buy stock of reputable blue chip companies. Stocks are risky. Yes, they are risky. But if you look at the trade off between risk and returns, and that's what we talk of, build a wealth that is balanced. You have fixed income instruments and you have fluctuating varying income instruments. So that when one market is doing bad, automatically the other one will be doing better. You can balance. You reduce the volatility of your overall income. But in terms of building your wealth, equity builds wealth quicker than any other form of investment. So 60 million is not at all older. If you look at, for example, those guys, if you bought Safaricom shares, they were trading at 5. But wajanja kama mimi, we expected over subscription. So we waited and I purchased at 2.5. Look at the current price right now at 17. But you remember it went up to 30, 40. Those capital gains, although we say it's paper money, it's paper money until you are able to liquidate or sell the share. But the good thing with the stocks, even if they go down because of a general circumstance in the market, they will obviously come up. And that the time when the market is bearish or the market comes down, that's the best time that we buy. Try equity and you'll appreciate. 60 million isn't such at all older. It's achievable. It's achievable. It's achievable. Because you can divide that big goal into smaller goals. Because for purposes of encouragement in investing, there are two ways. You start enjoying a part of the passive income, because a taste of the passive income fires you, gives you an inward fire to do more investments. And the other one is this: when you celebrate an achievement, it gives you more energy to achieve more. So if you need to divide your ultimate goal into smaller goals, and make sure that once you achieve a goal, you celebrate that achievement. It encourages you and pushes you to achieve the next goal. You'll attain it. You'll attain it. I remember earlier in my days in employment, I purposed to buy share capital in circles. I was a member in two, which I am also even to date. And one thing that I discovered that was very weird, it sounded and looked weird to many, was purchasing share capital. And I remember the first year I used around 400,000 and I bought $1 million worth of share capital. By that time, and that is over 13 years ago, that SACCO was paying us 10% return on dividend. My colleagues came to realize, or my friends realized, the impact when the dividends were being paid out. Because I remember I received about 88, no, close 90 something thousand on dividend alone before the interest rebate. That fired me up that in the next 3 years, I had done some serious work. And I've never regretted, because the amounts of returns, dividends that I've received on that capital to date, it's more than 3 times what I invested. So most of this risky investment, it's personal. The journey to financial freedom, your independence is personal. You get to tailor. And something else that I tell people, and maybe if you're a subscriber and you follow my videos, I have basic skills. I have very little skills. You can see I'm improving in doing videos because I'm learning how to edit my videos. One thing that I always insist is that these schemes that we have as forms of investment, those are businesses belonging to other people. And I don't think that anyone would establish a business as charity to help other people make money. That is something that you must have in mind. Those schemes, they sell as service, not a product, service. So as you approach the investment schemes, you need to know what you want as an investor. And that is what you bargain for. Because if you are not on a negotiating table with a scheme, you are in the menu. Because money has to be made at the end of the day. You need to know what you want. You need to know what you want. Then you venture in the investment market going for what you decided to go for. And that way, this is not at all order. You'll be able to achieve it. Yes, Simon. Simon, I need you to tell me whether you know Manza X. Do you know Manza X, Simon? So I will invite you. I'll be uploading the next video about Manza X. Manza X is, I've heard about it, but I don't have much information. Manza X is the newest kid on the block in terms of investment. It's a scheme. It's a fund like the notorious money market funds, but it's not a money market fund actually. It is more diversified. It's more flexible. The returns are beautiful. It's a product of Standard. It's a product of Standard Investment, and it's a good one. I will give you the details via that video. Let me not give you all the information by him. There's a video coming, but it's one of the best products that I've come across. It doesn't. You cannot compare it to any other platform that we have. It is also regulated. I know that is a question that lingers in mind. It's regulated. It's regulated. Actually, it was pioneered by SIB, and it has grown to an extent that it got the year to regulate. It is regulated by CMA. They have all those factors that we rush for under money market funds, But they are what the one thing that I like most about it is that their diversity is real. When we say money market funds and treasury bills, treasury bonds give us flexibility and diversity. The diversity that you get with the and flexibility we get with the Manza is so real because it gives you different products. It invests in real flexible and identifiable products. In the essence, when a money market fund will only look at because we have few near cash. We have few near cash investments because that will go for treasury bills, that will go for short-term commercial papers, and unlisted equities. But when you look at what a product like Manza X is giving, on above this, they will also give commodities and other. But that one will come. I'll give you all the reasons behind it. So, any other question before I wind up? Any other question, Simon, before I wind up? Thanks a lot. Thanks a lot for your time. See you tomorrow. Have a good night.